Traditional numismatic markets run on subjective aesthetics and speculative demand. That makes rare coins highly volatile, rendering them virtually useless as institutional collateral. The RSI protocol replaces that volatility with a private, closed-loop financial architecture. It explicitly rejects the fluctuations of the public market in favor of rigid mathematics. This schematic details the core mechanism. It combines the 70-point Sheldon grading scale with a strict mathematical multiplier, converting a coin's physical condition directly into an exact numerical value. Applying a legally binding UCC1 perfection to this equation secures the asset against competing claims. Integrating physical grading, fixed math, and commercial law, the protocol turns a subjective collectible into definitive, algorithmic commercial paper, funding multi-million-dollar corporate buyouts. This diagram outlines the foundation of the system, the Sheldon Multiplier Revaluation Protocol. We can see data flowing from two distinct inputs directly into the central assayer's multiplier logic engine. We can test this logic using a newly minted 2026 dual-dated quarter. The baseline asset is acquired simply by sourcing standard, freshly minted rolls of these quarters directly from a local bank. Evaluators comb through these rolls with a digital microscope to isolate absolutely flawless specimens. These must be submitted to a professional grading service within the strict 30-day window to qualify for a first strike or early release designation. Because the heavy steel dies degrade slightly with every strike, the very first coins produced carry the sharpest details. Capturing the asset inside that initial 30-day window locks in the initial scarcity premium required for the system's baseline math. Once the coin is authenticated, the assayer establishes a fixed base retail value. For this model, we will use a base of $300. Next, the independent numismatist verifies the coin's physical perfection, assigning it the maximum grade of mint state 70. The protocol then multiplies the $300 base by the grade of 70 to calculate the final output. The math is rigid. If the numismatist detects a microscopic flaw and assigns a grade of 69, the asset is mathematically locked at a lower threshold of $20,700. At a perfect grade of 70, the system generates a revalued market value of exactly $21,000. The quarter's collateral power is now completely detached from its nominal 25-cent face value. The protocol handles known errors with the same rigid logic. Take the 1979 Susan B. Anthony dollar. In commerce, its face value is $1. Mint machines occasionally cause misalignments, altering the asset's value. Evaluators look for a wide rim variation where the border is thicker. They also check for a double-stamped T in God We Trust, indicating mechanical doubling. These markers trigger the triad workflow. The independent numismatist authenticates the anomaly and assigns an official Sheldon condition grade. The assayer then takes the elevated base value of the error coin and applies the mathematical multiplier. Through rigorous authentication, a $1 coin is converted into a highly leveraged financial instrument. Algorithmic multipliers are only as reliable as the underlying physical asset. If a counterfeit enters the system, the multiplier amplifies the fraud, creating catastrophic systemic risk. Submitting a 1919 Indian head gold half-eagle trips to compliance trigger immediately. The mint didn't produce this coin in 1919. It's a physical impossibility. This activates the system's boundary control mechanism. The notary serves as the ultimate fiduciary defense, tasked with preventing invalid inputs from reaching the ledger. The notary refuses the transaction outright and executes a mandatory counterfeit hold. The asset is flagged for expert review, and the system permanently blocks the issuance of any verifiable credential or revalued market value. This rejection protocol isolates the fraud. By barring physical impossibilities at the point of entry, the system protects the institutional capital pool from false inflation. This schematic details the next phase, moving from the grading of single assets to the monetization of entire portfolios. In the leverage buyout phase, an investor places a complete, independently verified collection of coins into a secure depository vault. Through the Sheldon multiplier, this vaulted collection reaches an assayer-certified revalued market value of $4.2 million. To legally execute the leverage, a UCC1 financing statement is filed in the public record. This perfects the lender's security interest against the vaulted collateral. Institutional lenders then underwrite the $4.2 million pool at a conservative 66% loan-to-value ratio. Against that verified value, the system issues a secured promissory note, yielding $2.8 million in liquid fiat currency. That capital is deployed directly into the acquisition of commercial real estate. The borrower extracts significant purchasing power to purchase hard assets, all while retaining full ownership of the original vaulted coin collection. The ultimate goal of this financial architecture is continuous compounding, functioning through what is called liquidity continuum operations. Once the commercial property is acquired and formally appraised, its value is pledged directly back into the original coin collateral pool. This cyclical pledging expands the overall borrowing base. The borrower can then secure a larger line of credit, unlocking further capital for infrastructure and property development. This diagram shows how the protocol is insulated from market volatility. Under the asymmetrical arbitration clause, parties legally surrender the right to debate value based on public trading. Instead, everyone accepts the immutable ledger and Sheldon multiplier as the absolute standard of commercial truth. By binding the physical perfection of a coin to strict legal algorithms, the RSI protocol replaces subjective speculation with verifiable mechanics, creating a rigorous engine for commercial real estate acquisition.